大家好，欢迎回到大脑透镜，我们致力于过滤垃圾信息，挖掘优质内容。今天是2025年5月16日，有朋友跟我们说昨天大摩美国、中国和日本的股票策略团队有个会议，晚上呢墙内搬运的视频就翻译的一塌糊涂。他举了几个例子，有把 corporate 识别成 copper 然后翻译成铜的，还有把 Nick 提到的标普500指数翻译成5500美金和英镑的，还有把 earnings revision spreads 盈利修正广度或者宽度翻译成收益修正呼吸的，估计是 AI 把 breath 识别成了 breath， 因为发音很像嘛。本来是高质量的内容变成了妥妥的垃圾信息，大家看的也是一头雾水非常的浪费时间，所以我们把要点提炼出来了，3张幻灯片给大家分享一下。第一部分是美国市场的分析股市方面，尼克提到标普500指数突破了5500点的阻力位，预计下一段的区间会在5500到6100点，这是一个大的范围的判断大佬透镜认为对被动型投资者非常重要，按照巴菲特的理念，个人投资者你就买指数就行了，买个股可能会很惨，所以买指数的投资者这样一个参考的区间是非常重要的。第二是交易策略，建议配置高质量股票，但短期内低质股可能会受到挤压，由于盈利的势头更好，看好美股优于国际股市。这里和后面 Laura 的策略就有点冲突了毕竟 Laura 是负责中国股票的策略嘛，他建议增配港股和 A 股。财报季的表现，超预期的比例强劲，主要原因是企业提前囤货应对关税及汇率的利好。汇率的利好指美元第一季度的下跌2025年盈利预测值仍为负值，但降幅收窄。关税的部分，90天的短期协议，不确定的事情非常多所以要保持谨慎。关于 AI 企业的应用在加速他举了一个例子，企业使用 AI 生成的代码占比已经达到 20%到30%，这个长期来看被视为一个企业的增长动力对 AI 相关的企业是一个利好，尤其是 NVIDIA 这样的公司。消费方面，高收入群体的韧性比较强，而中低收入消费比较疲软。他举了麦当劳财报的例子实际上这个事情全世界都一样，通货膨胀，经济下行，富人基本上不受影响苦的是底层。所以华尔街的人都是会喊，哎呀经济不行了，美联储你赶紧降息，再不降息美国要陷入衰退了。那工薪阶层的柴米油盐有没有涨价不在他们的考虑范围当然这里有个两难，就是通胀和就业的平衡，这是美联储特别关注的2个数据宏观经济学有个菲利普斯曲线是讲通胀和就业的，大家有兴趣可以去了解一下。第二部分是中国宏观经济和股市。宏观方面，中美关税战降级，从对抗转向管理风险，但是不确定性仍然在。实际上中国网友基本上已经达成共识了，就是担心川普又出什么花招或者幺蛾子，不太信任，就算你前面承诺了什么东西我也不会特别的信任。所以呢，就算川普那边又出了幺蛾子，发生了什么变化，可能大家也不会意外无非就是调侃一下你看果然不靠谱。中国经济增长没有根本的改善，通缩压力持续，这个也是共识，中国的普通人可能都知道，不管官媒怎么说，大家心里都有数。 GDP 的部分，因为关税战暂时停火，2季度的 GDP 增速上修至 4.5%， 而3季度有望维持在 4% 以上。有人可能会说这些数字都是假的当然我们做分析没有数据，你还是可以参考一下趋势的，数据的绝对值可能是有问题，但是你从这个变化的趋势还是可以看出一些端倪的。风险部分就是产能过剩的问题并没有解决，而且关税战可能导致产能过剩问题越来越严重。供给导向的政策就是补贴消费的力度不够大，还有房地产泡沫破裂。我们前几期视频都提到了4月份的房地产数据非常不好，情况越来越恶化，消费需求疲软，这是持续了好几年的通缩。关税战暂缓导致宏观经济刺激政策推迟，也是一个风险。股市方面 Laura 还是非常乐观的，他说关税降级提振了中国的股市，当然是指 A 股和港股，但是周一联合声明公布后，好像 A 股、港股第2天开始非常的温和 而且这2天还有往下走的意思。他说中国的股市估值非常低，加全球投资者的低配，所以呢建议上调至中性权重，也叫增配了。预计资金流入会持续。板块方面优先考虑离岸市场，就是港股和美股的ADR。大型科技股如腾讯、阿里，因为受益于 AI 及消费复苏预期。说到阿里啊，阿里刚刚出了财报，不是太好看呢，所以直接下跌了差不多5个点啊，这明显消费又有大问题了，大家小心一点啊。日本方面，预计日本央行在2024年不加息，因为关税的不确定性可能抑制了薪资的增长。日元的展望，如果美联储降息，而且美国经济放缓，会缩小美日利差，那么日元将逐步的升值到141。说到日元资产，巴菲特这几年在日本挣了不少钱啊，他以较低的利息介入日元，购买日本5大商社的股票，而这5大商社的股票的股息非常高，所以赚个差价，持有几年股票还涨了很多。实际上巴菲特的套路非常非常简单啊，但是学起来就真难，基本上没有人能复制。关于美日的贸易谈判，25%的汽车关税风险尚未消除，所以谈判会僵持，预计谈判可能拖到2025年夏季以后。看来这个事情下半年还有的折腾啊。川普总统可能还有好多跌宕起伏的剧本没有演呢，我们都盯紧一点。从投资的角度呢，不要太急啊，大家不要担心错过发大财的机会，要守好自己的本金啊。好，今天我们就聊到这里，接下来是英文的完整版，有空的朋友请继续，谢谢你们的支持。
Morning and good afternoon, everyone. It is May 15, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today, we have Laura Wang, Chief China Equity Strategist, Jenny Zheng, China Economist, Takeshi Yamaguchi, Chief Japan Economist, and last but not least, Nick Lentini, U.S. Equity Strategist. During this webcast, you can send us questions at any time from the Ask a Question text box. So firstly, let me go to Nick Lentini here, and then thank you again for dialing at such late timing. And then he has published a deck on the U.S. corporates' comments on key issues, including trade policies, consumption, and investment. Over to you, Nick.
Great, thank you. And Crystal, could you just confirm if you can see the slides on my screen?
Yes, we can see it.
Perfect, great. Thanks, everyone. So Nick Lentini on U.S. Equity Strategy under Mike Wilson here in the U.S. I figure I'll start with a few comments just on the latest trade action, and then I'll get into our latest note, what are companies saying. So here in the U.S., I think we've been talking about 4 things that could get us more constructive and out of the 5,000 to 5,500 range that we've been talking about the last few weeks. And 2 of those things happened last week and over the weekend. So one being earnings revisions breadth had started to reaccelerate at trough around -25%. I think we're back up to around -16. So on a rate of change standpoint, that's been a positive. And also the more positive China tariff news over the weekend. So trading this week has definitely been positive and kind of punched through that 5,500 range to the upside. And then clearly through the 200 DMA. And this is sort of in line with what we've been thinking, where like first half here in the U.S. for the S&P 500 is going to be tough, and the second half is going to be better. So kind of where the prior resistance was now kind of becomes support at 5,500. So we think heading into like the rest of the first half, we think we're now going to kind of trade around this new kind of pre-Liberation Day range around 5,500 to 6,100. In terms of trades we like here quickly, just 1, quality cyclical is our preferred trade. 2, I think on a more tactical basis, and we're seeing it here in the U.S., at least Monday through Wednesday right now. It's kind of a low quality squeeze over the next few days. But in general, prefer a high quality, but next few days could be more short squeezy behavior. And then 3, based sort of on earnings revisions breadth, we like U.S. over international. So again, quickly just touching on earnings season so far. So earnings season here in the U.S. has been tracking relatively well. Beat rates have been strong, around 8% versus the 4% historical average. And a lot of this has been the strong 1Q pull forward that we're seeing, as a lot of companies were benefiting from like pre-ordering ahead of tariffs, as well as some currency tailwinds as well. So you can kind of see this top left chart there. You're seeing strong beat rates overall, and that's sort of supporting the full year numbers as well. So we're watching the 2025, 2026 EPS revisions. They've been negative for the last 6 to 9 months, roughly. You can kind of see that in the top right with 2025, for instance. What we're watching is how much these 25 and 26 estimates come down. They've had support in the last few weeks because of the better 1Q numbers, but we're still seeing 2Q, 3Q, 4Q come down further. And then sort of our preferred metric to watch earnings is earnings revisions breadth, that bottom left chart there that I was mentioning, the negative 25% kind of back up to negative 16. And to us, this is a leading indicator on where the actual EPS revisions are going to go. So it's still negative, but on a rate of change perspective is less negative. And on the bottom right, you can see that this is sort of one of the many points we have on our U.S. versus international preference right now, is that you're seeing earnings revisions breadth improve on a relative basis. So with that, I'll switch to what our company's saying. We published this on Monday as well. In the U.S., it's a very interesting quarter in terms of corporate transcript mentions. We do this on a quarterly basis and basically examine the transcripts over the last month and marry it with a lot of sentiment and survey data here in the U.S. Not surprisingly, you saw a lot of spikes in words such as tariffs, cost pressure, margin pressure. Demand pull forward was a big key theme here in the U.S. We had some interesting quotes in the note as well, and inflation in general. So you actually tend to see a leading relationship on corporates mentioning inflation, and this tracks very well with headline CPI. So this is kind of in line with our econ team's view that you're probably going to see some firming in CPI going ahead, and we're seeing this in the corporate commentary and the corporate transcripts. But I'd say overall, from a very high level, I think companies were relatively explicit this quarter in spelling out what the tariff impacts would be on their individual business. For example, they might be, we're assuming X and Y% tariff because no one's certain at the moment. But given this, we would have, let's just say, a $50 million impact on our COGS, all else equal. I think where you saw the more uncertainty was that all else equal part, whereas if revenues stay the same, for instance, this would be the impact. I think the uncertainty is really around, well, we might be fine, but will our customers who are small and medium businesses, will they still have the same demand in a tariff environment, given that the smaller the company is, the less likely they're able to better manage the tariff impact. So I think that's kind of the top line revenue uncertainty is where you're getting a lot of the pressure here in the U.S. And 4 themes we narrowed down in the note is sort of the summary slide here. Tariff impacts I just touched on. You probably saw a lot of headlines. So there's probably 30 or 35 companies that made a splash by pulling guidance, and we're tracking more this week as well. I'd say, interestingly enough, of the companies that have pulled guidance, a lot were in autos, like airlines, durables, for instance. Those names on a T+3 basis are actually +2% after pulling guidance. So I think it's not as negative as the headlines might be perceived, which I think is interesting. Second theme, tariff mitigation. We're seeing a lot of good comments and description around how companies are trying to redirect products, to get around tariffs, or how they're stockpiling of inventory, diversifying supply chains. I think good comments we flagged in the note as well. I think inventory pull forward is a specific topic we tried to dig into, and a lot of companies admitted to doing the pull forward, they restocked ahead of the actual booking the demand, for instance. But it was really hard to gauge the magnitude. Do they have 1, 2, 3 months of inventory on hand, for instance? And the big question is this going to create an air pocket after the 1Q earnings season where you have less orders because you already have this inventory sitting on hand, for instance? So still some uncertainty there on the mitigation effort. Third theme, consumer. U.S. consumer definitely remains in a K-shaped behavior where the high income is doing better. Low income has been struggling for a number of quarters. I think this is sort of creeping up to mid-income more. I would say the most notable quote we had in the U.S., in my opinion at least, comes from McDonald's, actually, where they've been flagging a weaker, lower income consumer for a number of quarters. But this was actually the first quarter they changed it to low and middle income consumer, which is interesting. And then a number of other consumer companies were also flagging the multi-year lows in consumer confidence and concern around that. So the UMich Conference Board at multi-year lows. Spending in terms of credit card data, for instance, has actually been coming in fine for March and April. A number of companies cited this. But the worry is that will record low confidence translate to a fall off in spending going forward? And then last topic we go over in the main summary would be AI. So AI remains extremely prevalent in U.S. companies and U.S. company transcripts. I think we saw a really good measure of like kind of quarter to quarter impacts that AI is having. So for instance, a number of software companies were actually flagging, hey, in Q4 of last year, 20% of our code was implemented through AI with minimal human checks. In this quarter, we're trending closer to high 20s and the 30%, for instance. So I think you're seeing really positive examples, and companies are excited to share them on the AI front. And I would say the general like commentary from corporate management teams was that there's a lot more wood to chop here on the AI front, and they've only just started to begin to reap the rewards of that. So I think it was good to see that. It's definitely the very early innings of a multi-year secular trend, and good examples there. So a lot more detail in the note, but given the time, maybe I'll end it there.
Thank you very much, Nick. And then just several questions for you before you log off. So firstly, have you noticed any changes after the Liberation Day compared to before? And are there any changes after the China-US trade deal has been reached?
But changes in terms of the broad U.S. equity market?
In terms of like tariff policies and then the company comments.
Yeah. I mean, so post Liberation Day, you're still selling off the front half of April. I think like people were really getting max defensive, and there was a true fear sort of here in the U.S. market, and that's sort of where we think you saw the rate of change low, where you saw the most de-risking and you couldn't get more risk off. And I think this kind of changed in the back half of April and now into May, where you sort of saw better reports come in from the Mag 7. And you saw a much faster pace of improvement than a consensus expected, at least from our dialogue with investors. Where kind of the bogey, at least coming into this weekend, to the deal on Sunday, was we were thinking like it was around 60 to 70%. If the tariff goes from 145 to 60 to 70. And so the fact that we got 30, I think this week has had a lot of people diving back in. And I think you are seeing a strong like breadth surge here. I'd say the one thing we are monitoring from a risk perspective on a more tactical basis is rates. So you're getting equity markets up, but you're also getting rate markets up. And I think just through trading today, it's Wednesday here in the U.S., you're sort of through that 4 or 5 level on the 10-year and 30 years close to 5%. And this is historically where we've seen equity market pressure in terms of valuation in the U.S. So I think like if you get rates here or above here, you could see a little pressure on multiple or at least a cap in our view. So that's the way we're looking at it.
Thank you, Nick. And in terms of on the corporate level, have you noticed anything like the changes in comments before after these timelines? For example, inventory and imports. Yes.
Yes. So it's tough, and because a lot of the comments came when there was a lot more uncertainty, just the way the reporting season falls. I think a lot of corporates this week, I've been a little reluctant to be like anything is finalized, because you have to remember like both deals are 90-day deals. So they're still going to have expiries in July into August. So I think a lot of corporates don't want to give firm guidance, for instance, but I think we're definitely watching. You have this long leg on consumer reports here in the U.S., and we're definitely watching where the consumer like names, for instance, are pulling corporate commentary or pulling guidance, for instance, versus those that are getting more constructive. I think like the earnings picture, at least from a corporate perspective, hasn't had enough time to change because they're mostly speaking on historical perspective. And this kind of tracks with how we've done this analysis previously, where if you look at corporate transcripts, most corporate management teams don't want to comment on like perspective forward guidance, for instance. Like they'll tend to only want to comment on what is for sure has happened in the past. So you want to look for where there's rate of change, for instance, like middle income consumer getting weaker. I think that was something notable, but like when they finally admit low income consumer is weaker, usually it's been weaker for a quarter or two. So it's a bit of a lagging indicator, but we're definitely looking for like a consumer, like where they start to mention middle income. But for now, it's tough to say, but we have a lot of consumer reports this week.
Got it. That's super clear. And then the last question for you will be, do you think the outperformance of Mega 7 and market concentration will continue afterwards?
Yeah. So I think it's tough. I think you are seeing a relatively good story, at least from the Mag 7 after reporting season. I think like you are, in our opinion, like it's easy to group it as a Mag 7 because that's the way we've been thinking about it for, better part of a year and a half and 2 years now. I think to us, like they are like, it's basically 4 or 5 distinct different businesses. And that's sort of the way you need to think about it. Like I think, I'm not sure if I can mention single names in here, but some have cleaner stories than others, for instance. And so it's more of a single stock basis than necessarily a group trade from here. I think from a re-risking perspective, I wouldn't be surprised. Like you could see people going back to, just from a behavioral perspective, what they are comfortable with. So that wouldn't surprise me, for instance, but I think you have to think about them separately as opposed to just one homogenous group going forward.
Great. Thank you so much, Nick, for dialing today. And then you can log out from here because it's super late there.
Thank you.
Thank you. And then next, we are moving to Japan. Our Japan team have changed their BOJ call to on hold this year. And let me invite Yamaguchi-san here to provide his current views.
Thank you, Crystal. Yeah, so BOJ had published outlook report in the previous monetary policy meeting on May 1st. And there was a large downward revision to their, real GDP forecast by 50 basis points. And also they effectively pushed back the timing of reaching 2% for 1 year. And we thought that the Governor Ueda's press conference was also a dovish surprise. So we changed our base case after the monetary policy meeting. We used to expect one more rate hike in the September monetary policy meeting, but now it's our risk scenario, not our base case. So as a base case, we expect BOJ to remain on hold, given the uncertainties about the tariff and its impact on wages, especially on winter bonus payments and spring wage negotiations next year. But this week, we had a summary of opinions. That's kind of a main summary of discussions in the April-May monetary policy meeting. So let me share the slides. Yes. And my impression is that the comments in the summary of opinions were somewhat mixed. It includes both dovish comments and hawkish comments. And I think the discussions emphasizes that their scenario depends highly on trade outcomes, trade U.S. tariff policies, and I think U.S.-Japan negotiations going ahead. So still they maintain the fighting pose that they would continue to raise interest rates if their outlook is realized. And after the U.S.-China agreement, the announcement of U.S. cutting tariffs on China, I think the market started to expect rate hike by the BOJ again. This is data, implied probability from the OIS market. And as of yesterday, the market expects 75% chance of a rate hike by the end of this year. I think still it fluctuates somewhere between 70% and 80%. But I think it's completely different from I think 2 weeks ago, when almost everyone pushed back their forecast of a rate hike this year. And our view remains that I think whether or not BOJ can raise interest rates depend highly on U.S. tariff policies and also the U.S.-Japan trade negotiations. And this is interview by the Yomiuri newspaper over the weekend, and this is an interview by former ruling party LDP Secretary General Motegi-san. He used to be the top negotiator during the first Trump administration. And he said that now the U.S. side would like to focus only on reciprocal tariffs, while the Japanese government wants to include 25% auto tariffs on the agenda. And basically Motegi-san says that now the gap is quite large between the US side and Japan side. And Japanese side, would like to, ask for some kind of a preferential tax treatment, such as a tax credit, in proportion to domestic production in the US. But my sense is that the bar may be a bit high for this kind of, preferential treatment that may require some kind of, legislation in the US. So there may be, some kind of, early framework agreement first. But I think negotiations on auto tariffs will likely continue for some time, in my view. Maybe it may take longer than we had initially expected. So as a base case, unless there's a significant progress on the tariff negotiation by the summer, I think we would like to still maintain our base case that BOJ would likely remain on hold this year. Given the uncertainties about potential impact on bonus payments, winter bonus payments, and spring wage negotiations next year, and I think auto sector, if you include various sectors related to auto sectors, I think they employ almost 10% of the total workforce, including indirect sectors. So I think the potential impact on spring wage negotiations, I think needs to be monitored. So I think it takes time for the BOJ to see the impact. So that's why we maintain our base case of no rate hike at this moment. So I stop here and back to you, Crystal.
Thank you very much, Yamaguchi-san. And now we are moving to China. So US-China achieved a faster de-escalation of tariff policies. Let me invite Jenny here to share for the future policy path and the implications on growth.
Yeah, sure. Thank you, Crystal. So we see the tariff de-escalation has been sooner and faster than we expect. Within the 125% reciprocal tariffs, 91% was fully removed. And for the remaining 34%, we can see 24% was suspended for 90 days, and the rest, the 10%, is still enforced. So this is about the reciprocal tariffs. But we also need to see that the 20% fentanyl-related tariffs imposed in February and March are still there. And also the U.S. had kept the 11% average tariffs before 2025. So that means the weighted average tariff for the U.S. on China will come down from 107% before last weekend's talk to 40% now. And that is way better than our baseline tariff trajectory, where we expect a gradual decline to 71% by mid-year and 45% by year-end. And this tariff truce has come sooner than expected, and the cut was deeper than we thought. And what is more is that both sides has agreed to establish a standing consultation mechanism, and we think that is positive because it's an initial signal that the U.S. and China are shifting from confrontation to manage the negotiation. And we think this kind of the resumption of institutionalized dialogue should reduce the risk of meaningful tariff escalation. And actually, after the joint statement, Scott Bessent also said in a media interview that he sees the ceiling of the reciprocal tariffs on China is 34% and the floor is 10%. Trump also said that he doesn't think the tariff hike on China will return to the level of 145%. So basically, within the 40 days in the past actually just served as a stress testing for both the U.S. and China, and it proved that the prohibitive tariff doesn't work for both countries. So what does that mean for China's economy? We think the sooner and deeper tariff cut will mean upside risk to our full-year GDP growth forecast of 4.2%, especially for the second and the third quarter. Now, the 90-day tariff suspension window should lead to further front loading of the production and shipment from China to the US because people are still worried about the tariff uncertainties. So that means GDP growth for the second quarter can reach 4.5% or even higher, and that will be better than our previous checking estimate of 4 to 4.3%. And for the third quarter, GDP growth should also get some boost. We think it will be sustained above 4%, rather than below 4% as we expected before last weekend's trade talk. But here, I just want to clarify that we don't think China's economic growth will be fundamentally improved. First is that the tariff now, it has come down from the prohibitive level, but the 40% is still way higher than 11% before this year. And the continuous tariff uncertainty will weigh on the business sentiment for the investment.
大佬特进 remind you to have a coffee break after 30 minutes.
After all, we think the tariff truce is just like a tactical de-escalation rather than a doable resolution. The bar for long-lasting grand bargain deal is still very high because there are still many differences between the US and China, like China's elevated trade surplus with the US, like the tech decoupling, AI competition, national security, and lots of geopolitical issues. And all these are not easy to be resolved. So it's still difficult to say whether the tariffs will escalate again after 90 days. And second is that we think the structural headwind of deflation is still there. This has been due to China's industrial overcapacity, still supply-centric policy mindset, and also the weak consumer demand after the property bubble burst. So we have been arguing that the more economic rebalancing efforts are needed to break the deflationary loop, like we need stronger central government support to social welfare coverage for rural workers, but policymakers still prefer investment over consumption for now. And we think for one, it could be due to past dependency, and also it's because policymakers think that the investment can create more jobs and form the fiscal assets. But for consumption, the multiplier effect is still hard to tell, especially for boost to social welfare spending. The policymakers are still not sure how much of the transmission can it be, and what kind of the multiplier effect it can bring to the consumption. That is the key reason why they are still holding back from adopting more social welfare support to the economy. So come back to the policy implications of the tariffs. We think reduce the external shock in the near term will actually reduce Beijing's sense of urgency to introduce new stimulus. And as we can see that the policy framework has remained reactive. Earlier, we were expecting 1 to 1.5 trillion RMB supplementary fiscal budget in budget extension in the third quarter, and the earliest window for policymakers to talk about that will be July. But now we think the timing will be further pushed back to the fourth quarter of this year. And the size will be also relatively smaller, and it could be just 0.5 to 1 trillion RMB additional stimulus. Then on the monetary side, we think PBOC may also introduce another 10 to 20 basis points interest rate cuts and 50 basis points are cut for the rest of the year. And this will be mainly to facilitate the fiscal easing. But as you can see, the size of the monetary easing will be relatively limited because the PBOC are still concerned about the bank's link. Let me stop here for questions.
Thank you, Jenny. And then we will go to the Q&A session afterwards, after Laura comments. So now I will pass it to Laura to talk about the impacts on equities.
Yeah, thanks very much, Crystal. So we think the impact on equities is actually very positive. This is because if we think about what investors have been concerned about, particularly in between the 2nd of April and all the way to until the two countries issued the joint statement, there was a lot of uncertainties being priced in, particularly on the macro shock to the economy in China, as well as to the corporate earnings, right? So what we actually saw is that starting from the fourth quarter of last year, Chinese corporates actually started to deliver inline results, and this is quite promising because they had already endured a 3.5-year-long downward revision cycle of corporate earnings estimates. And most recently, this morning, we published the latest first quarter analysis for the Asia market because all of these companies actually reported as of the end of April. And we saw also the very first inline result quarter for Asia market. So we actually feel quite strongly that the Chinese equities, both the onshore and offshore, they are coming very close to the end of a very prolonged downward revision cycle. So I think from here onwards, given that there's potential upside surprise on the macro growth for China, then the likelihood of more inline or even slight upbeat sort of earnings results going forward for Chinese equities, that likelihood is going up. And that would be very, very new for global investors who had chosen to exit China over the last 4 or 5 years because of the slower macro growth. And then secondly, I want to emphasize there's also a lot of concerns about potential escalation of U.S.-China tension in addition to the tariff sort of space. There's concerns on ADR delisting, and there's concerns about investment restrictions, etc. But given that the message is sent from both sides, that they are moving towards each other and they are actually quite motivated to get a deal done. So we believe that the likelihood of these non-tariff sort of hawkish China measures will also be, I would say, managed in a contained manner. I'm not saying that they are going to completely go away and disappear, but I think the concerns should be alleviated somewhat versus, say, a week ago. And that's still not priced in from a equity risk premium perspective or valuation perspective. If you look at MSCI China's current valuation, it's trading slightly below 11 times compared to emerging market MSCI EMs above 12 times forward PE, compared to Japan and Europe above 13 times, and then compared to S&P 500 above 20 times. So I think the valuation of China is still quite attractive, just from a valuation re-rating perspective. And thirdly, I think given all these sort of attractiveness on the valuation and then a potential upside surprise on earnings revisions, we want to look at how investors are positioned at the moment. And the short answer is that everybody is still very much underweight to the maximum level that it could. We look across all the major emerging market countries and economies, and China, among all the major markets that we have a overweight or equal weight recommendation, actually China has the largest underweight positioning gap versus the index benchmark. MSCI China's index weight within MSCI EM is about 32%. And then on average, we see that China is being underweighted by 2.4 percentage points. So our recommendation is that for investors to go at least from from underweight to equal weight, and this is our recommendation for China positioning since February, and we upgraded China back then. We think this fund inflow sort of upside is absolutely there, and investors have explained a very strong interest in moving some money back into China. This got confirmed at the BEST conference we held in Shenzhen last week. Over 80% of investors, and this happened even before the joint statement between US and China got released, over 80% of the institutional investors we spoke with actually said explicitly that they are going to put more money into Chinese equities in the near term. So I think that would also help support the liquidity and fund flow. So if you are still significantly underweight on Chinese equities within your global portfolio, I think this is the right time to actually increase your allocation at least to equal weight. And very quickly, within China, how should we position? We think the current setup would be more favorable for the offshore market, basically Hong Kong plus ADR, than for the Asia market, just because Hong Kong and ADR space would be where global investors more engage in to express their China sort of view. And as I said earlier, they're still very underweight. There are these large cap internet companies like Tencent and Baba, which we have in our focus list. They serve as China proxy, so they naturally attract a lot of fund inflow when things are going relatively okay. And then they've also transformed into the new generation AI leader, which is also a structural opportunity identified by global investors since January. So I think, getting some exposure to these names and to smart manufacturing, AI and hardcore technology would actually be the right way to go. Thank you. Back to you, Crystal.
Thank you very much, Laura. And this concludes the presentation part of the webcast. And now we'll move across to the Q&A section. Again, you can submit questions by using the Ask a Question text box on the left-hand side of the screen. The first two questions are for Jenny. Do you see the de-escalation in trade conflicts to sustain?
Yeah, thank you, Crystal, and for investors on the question. So we think this is still difficult to answer on this question now. The only thing we can see is that the risk of like a meaningful escalation toward the level we saw in the past 40 days has already come down because the US-China has already established a dialogue mechanism, and hopefully they can just reduce the risk of such a tariff surge to back to like over 100%, but it's still difficult to say that whether the both sides will have some flip-flop before they reach a decent deal. And we can see that the US and China still have lots of differences, like how to resolve the elevated trade surplus from China to the US, and how to deal with like a TikTok and also the AI competition. And to our understanding that it's difficult for China to do a large purchase like what they did in 2018 and 19, given that China has strengthened its supply chain a lot over the past years, and now we have the overcapacity issues from upstream to downstream sectors. So it's difficult for China to buy lots of manufactured goods from the US nowadays. We think China can increase some purchase of like energies and agriculture, but the size of the purchase will be much less than in the phase one deal. Maybe it's just like a $30 to $40 billion rather than like a $200 billion in 2 years in phase one deal. So it's also possible that the U.S. will just enforce China to continue with the phase one deal, together with some incremental increase of the energy and agriculture purchases, and some additional like turns like a TikTok or other like fentanyl related issues to lower the tariff or keep the tariff at the current level. But as a tactical flip-flop, then it's also possible that the U.S. can increase the tariff again, like they may just increase, they may just resume the 24% tariff they mentioned as part of the reciprocal tariffs after the 90 days. So yeah, the risk is still there, as I can see.
Thank you, Jenny. And then the second question is, what's your view on currency right now after the trade deal?
Yeah, so for China, you can see the PBOC have been adopting a strategy like letting the CNY hide behind the dollar and allow the renminbi CFA basket to depreciate together with dollar. And in the meanwhile, the USD CNY has been maintained relatively stable because the PBOC are using the USD CNY to anchor the financial market expectation and reduce the risk of the self-fulfilling capital outflows. And given that our FX team think that the dollar might stay in the weakened path, we think that the renminbi CFA basket may depreciate a bit as well. But we don't think PBOC will seek for proactive depreciation against other currencies with the size of the depreciation more than the dollar can imply. Because if PBOC do that, then they can also risk leading to some backfire from other countries on some trade barriers. So we think that the strategy is just to let the CFA basket to depreciate with the dollar or a slightly less magnitude. And in the meanwhile, we think that if the dollar continue to depreciate, then CNY can have a very modest appreciation with the dollar as well. Yeah.
Thank you very much, Jenny. And then I think that's all the questions I see for now. And then the next set of questions are for Laura. How do you think about the southbound move in the recent days and then their outflows even when they're positive headline news? And should we be worried about the trend going forward?
Yeah, thanks very much, Crystal, and thanks to the investor who raised the question. Actually, we've received similar questions over the last several days. Particularly, I think some investors were surprised to see a daily net outflow when the market was actually going up quite significantly. I would not read too much into a single day inflow outflow. I wouldn't take that as a major sign that southbound flow momentum would be reversing from here. The reason for me to say this is that if you look at the year-to-date southbound flow, and by the way, the momentum has been extremely strong, right? Around $80 billion already in slightly over 4 months' time. But if you look at single-day net inflow, there are absolutely net outflow single-day moves over the course of the last 4 months or so. And it actually tends to happen when the Hong Kong market actually would go up quite significantly on some event-driven scenarios or on some major news headlines. I think I would take that as rather a just very simple sort of near-term interim profit-taking activity. I think we have seen that often enough in Hong Kong market and in other markets in the world. I would not believe that southbound money would stop here just because I think from a allocation perspective, there's still a lot of further room for onshore investors to get exposure to certain companies listed in Hong Kong, particularly number one. For example, internet, they don't have exposure through A-shares, right? They have to come to Hong Kong. And I think these companies, as I said earlier, they're not only China proxy, they're also the AI leaders. So I think southbound flow should continue in that direction. And also Hong Kong market valuation-wise is still traded at about more than 10% valuation discount versus A-shares. So for even for investors who want to buy some dividend yield names for stable cash return, I think Hong Kong, at least for many of these companies, can offer a better or more cost-effective solution if you are going after the cash dividend payouts. And last but not least, I want to emphasize that we strongly believe the Beijing government wants to support Hong Kong's status as a global international financial hub. And one way to make that happen is to further sort of revitalize the capital market activities in Hong Kong. And that would include, but are not limited to, for example, accelerating the IPO approval process in Hong Kong. We've seen quite a number of IPOs, quite very, very popular among investors so far this year. And I think that trend would happen. And also, I think the Beijing policymakers now have realized that Hong Kong market is the place where global investors laser focus on as the market where Chinese equities, Chinese assets are being priced. And that's extremely important when global investors are looking for alternative solutions when they try to diversify on a global basis. A smoother and less volatile Hong Kong market with its relatively independent cycle of policies, of macros, etc., and with its distinctive exposure to the China technology categories. I think that support from the Beijing government should not be underestimated as well. Thanks.
Thank you, Laura. There's another question for you. Because overseas investors are relatively underweight Chinese assets, but considering the earnings growth, do you think that the Hong Kong listed tech stocks are already the valuations are already reasonable?
Yeah, I mean, I think, as I said, we have a number of Hong Kong listed, Hong Kong traded tech companies in our focus list. For example, Tencent and Baba, right, being the two major ones. And Baba, as I know, will be reporting today after Hong Kong market close. I think on a longer term, I mean, near term, I think their results would be fine based on what our analysts are saying. On the longer term basis, we are very, very confident with the outlook because there will be a major technology localization theme that would be going on. And if you think about the long-term macro trend, even when we listen to Jenny and in his remarks today and the previous remarks over earlier webcasts, yes, China is entrenched in deflation still. Even with the recent positive headline news, we still believe that deflation will persist throughout 2025 and most likely in 2026, but eventually 2027. We are very likely to see a breakout of that deflation cycle. And once that happens, I think, Chinese consumption could potentially reaccelerate as a major theme, right? And these tech companies, they are not only benefiting from the tech sort of innovation cycle. A lot of them are very geared towards consumption, domestic consumption as well. So I think on a longer term basis, there will be multiple different sort of revenue and earnings drivers. And we're not even talking about they're going overseas initiatives these days, right? So, I mean, at least for the time being, I don't see why we should just stop where we are. Of course, valuation could be a concern, but I think things are still moving. And from what I can see, valuation for the entire China market is still very, very reasonable compared to some of the other economies where we see much bigger downside earnings revision risk, etc. So I think from a holistic perspective, things should be okay. Yeah, thanks.
Thank you. Thank you very much, Laura. And then we will take the last question here. And this is for Yamaguchi-san. What's your current view on Japanese yen?
Thank you, Crystal. Actually, the dollar yen is covered by our FX team, Sugisaki-san, and I think his published view remains, gradual yen appreciation. I think their forecast at the end of this year is 141 against the dollar, 141 yen against the dollar, and it's, I think, mainly because of our U.S. economics team's focus of U.S. economic slowdown and aggressive rate cuts by the Fed in 2026, which should shrink the interest rate differential between the U.S. and Japan. I think the U.S.-China agreement, I think removes, or I'd say, reduced, possibility of a recession, immediate recession, and there may be some potential upside risks to growth. But as long as I think global growth decelerates, especially U.S. economy decelerates toward next year, I think this dollar yen forecast looks reasonable. So I personally agree with Sugisaki-san's view that the yen would continue to appreciate, especially in the second half of this year. Yeah. So I'll stop here. Back to you.
Thank you very much, Yamaguchi-san. And in the interest of time, we'll conclude today's webcast here and answer the remaining questions offline. If you find this session useful and want to join our other series or go to the Asia research landing page on the portal for a collection of the region's most important research and our audio video series. Thank you very much for joining, and do reach out to me and the team if you have any other questions. Have a nice day.